I got to ask you, are people just looking for any reason to sell right now?
Yeah, I think risk management has come in. We've seen this increased volatility for the past week, and as volatility has increased, I think people are being told to sell, cut their positions, which is a very natural reaction to that. And we're seeing really strong evidence in that today, in that the most shorted basket that we follow is actually slightly up on the day. The Russell 2000 may well be up by now, and that would have been a big underperformer. And the S&P's down hard, and actually XLF, which had barely been down at all, is down very hard. So I think people are reacting to calls from risk management to reduce position size, so they're selling what they can, they're reducing line items by buying back some of their shorts, but net, that's pushing the market much lower.
Okay, is this healthy yens? I mean, should we expect this, given that we've seen such a run-up? I mean, is it normal to see a pullback like this?
Well, we always expected that the fourth quarter was going to see much more volatility. Obviously, this is extreme volatility, what we're seeing now, and I think some of the explanation has to do with the fact that we're going to be having less support from the Fed. The ongoing liquidity injections we've gotten used to are not going to be there anymore after this month, so that's a part of it. But I think when the news comes out and when we have risk reduction like this, you can't come up with a fundamental explanation. It is a risk reduction that is across the board. The most popular positions are being hurt. Today, we had a big squeeze in the dollar in the middle of the day. It's not because people don't like the dollar, it's just because they had too much of it and they're cutting those positions as well.
Wow. Go ahead.
You know, I've got to say, people, Dave Zervos was on earlier, and he was saying that part of the reason why for today's move was because the Fed withdrawing liquidity, ending its bond purchases this month. But this has been telegraphed very, very well, that they were going to end their bond purchases. I don't know that that's really what's behind it. It feels more like, I mean, if anything, people are thinking, well, what if the Fed is out of tools and our economy is not accelerating enough, especially with oil prices coming down and sort of the weakening.
I got to say, it certainly seems as though the Fed is out of tools, because we were talking about this just the other day. If they were to suddenly embark on QE, it would terrify people.
Right.
So they can't do that.
Well,
all they can do is keep rates low.
It's also to do with, if you look at it from a global perspective, there was this hope that the European Central Bank was going to sort of step up when the Fed was scaling down. And what they're doing at the moment is maybe buy assets like $10 billion a month. It's just not nearly enough to substitute. So that's why we're in a little bit of a liquidity vacuum, and that's making the market more vulnerable.
And I think it's even worse than that, too, because really, if you take a look at energy, which started a lot of this, that energy sector is selling off very hard. You're seeing bonds down at 25 cents on the dollar for some of these companies. So there's really, first time, I think, in this past year, we've had some little sell-offs here or there, but it's always been either liquidity-driven or what will the Fed do. You're actually seeing some real credit fears. Hey, some of these companies might have a default. You're seeing the stocks hurt, and people are starting to say, hey, what's out there in mining that looks like that? What's out, you know, we had that GTAT, the ticker symbol, which was a surprise, you know, bankruptcy based with Apple. So this is really adding a new element. It's not just the Fed. There's real concern that people have been sloppy and lazy and mispricing assets.
Well, I've been on this bandwagon for quite some time, Peter.
Right.
You know, and my fear about all of this all along, Lisa, has been that people are not accurately pricing assets because they have this Fed that's, you know, been there, willing and able to support throughout it. So it hasn't really forced the kind of discipline that you would see in a normal stock market.
Right. I think there's
the law of unintended consequences.
Although in the bond market, I mean, I think people are questioning, they're scratching their heads, and they're saying, if we thought that yields were going to rise at 2.5% to 3%, and they've come down to 2%, maybe we're just miscalculating things. Maybe our models are all skewed. And I think that it's forcing people to sort of sell, to what you're talking about, to sort of sell their short positions and say, forget it, we're going to capitulate because we don't understand this market.
And I think that's the other thing that's been going on a lot of this market. It's very easy to say, hey, if I'm down 3%, I'll buy more or short more. When you're actually down 3% in your position and you're staring towards year end, you know liquidity is going to be even worse next month. I think you wind up selling rather than buying more. So that's happening. It's feeding this concern that liquidity is low, year end could be bad.
Is there anything you buy right now? Jens? The U.S. dollar?
I think what you want to think about is the risk reduction we're having. Is it going to lead to a tightening of financial conditions that's actually going to feed into the economy? If that's not the case, then eventually markets will come back. So I think this feedback loop is what you really want to look at. When I look at Europe today, I can see that peripheral spreads, Italy and Spain, are widening a little bit. That makes me worried because that's generating a tightening of financial conditions that really could be meaningful. Those are the things to look at.